Welcome back to our podcast. Today, we are speaking with Chris Albinson. Chris is very much into the Silicon Valley startup environment. He's been involved in that space for quite a number of years. And Chris, there's a lot going on in that space. There's on both the academic and the practitioner side. On the academic side, almost every university and college is interested in startups and entrepreneurship and trying to provide structure and methodology around the startup world. For example, we've seen the lean startup idea, or the idea of taking startups and testing them, validating them with customers right away. Just get something going and then look at the metrics that come out, versus the traditional business plan research approach that we may have seen in the past. And on the practitioner side, we're seeing all kinds of support structures come into place, all kinds of incubators and accelerators, all kinds of community associations that look at bringing together entrepreneurs and new thoughts in terms of investors switching from the validation and shared distribution to safe agreements. So it seems to me there's a lot of moving parts in the startup entrepreneurship space. And I'm wondering what your perspective on is in terms as we go forward, particularly in the technological era that we're entering in. The cost of startups, the business model of startups is changing so rapidly. Is this model that you've seen of community support and investor perspective still hold, or are we going into another type of environment for the startups?
Well, I mean, I think it's always been evolving. When I first did my first startup, when I was at the Ivy School of Business, while I was at school, it was a very different environment trying to do startups in 1990 than it is today. I think the biggest through line is the size of access that we now have to markets, the lowering cost to launch concepts and products, partially because of easier access to markets through devices like mobile or SaaS platforms, but also I think the lowering cost to build these companies. So things like open source that we talked about earlier, but I think even probably more importantly, a lot of the foundational blocks of my previous startups. I've done 4 startups and 2 venture capital firms over 25 years. And so, really kind of done startups, I guess, in different forms, different ways. But, the biggest structural difference really has been cloud compute. So if you look at my last startup, a company called Digital Island that we took public in 1999, that company consumed over $300 million of capital to get launched and ultimately get public, and ultimately got to about a $13 billion market cap. Because of cloud compute, that same company today could be launched for a fraction of that cost.
And that's really cool that business model is changing. And that suggests to me that we should see much more innovation taking place, because if the cost of starting a company drops, then that means more people with more ideas, more innovation, and a much quicker speed of development in many different opportunity spaces. As well, it suggests that people in a variety of different parts of the world participating in the startup space, maybe through virtual teams. What is the impact that you're seeing in terms of the way investors are approaching this, or kind of the community support structure that's taking place? We often talk about that startups should have the support of communities, and there's a number of associations that do that. What are you seeing evolving on that side of the fence?
Yeah, it's really fascinating to see some of the change that we've seen. My latest firm is a firm called Founder Circle Capital, which is really grounded directly around data. And so we have an exclusive partnership with Silicon Valley Bank that allows us to have access to all of the data that private companies around the planet that are venture backed, and we went and looked at that data to try to answer a pretty simple question, which has a very complex answer in startup land, which is, when do you have a 90% probability of success? There's a lot of math that kind of sits behind that answer, but the short answer is what we call the 40 rule, which is a company, if it can achieve 40 million in revenue with 40% growth and 40% gross margins, you have a 90% chance of outside success at that point. We define that as an exit at or around $1 billion. And so the math behind that is fascinating. But to your main question, there's only 631 of those companies on the planet today. And so it is rarefied earth, to be sure. Most of those companies are located still in San Francisco and the Bay Area. We're seeing some really big structural changes to where and how companies are being started and where they're having success. So, of those 631, that's only represents about 0.3% of companies that get started. And so that's not to say that every company that starts should have that aspiration, but I think it's also a little bit sobering. I think for young entrepreneurs especially, that went and saw The Social Network and thought, I'm just going to go do this for 4 years and be Mark Zuckerberg and be a billionaire. I mean, the odds of, achieving that are less than, winning the lotto in Canada right now.
That's really interesting to have that data analytics approach. And when I think of young entrepreneurs starting companies, and as you mentioned, there's this illusion that it's just a couple of days of hard work, an internet site, and then we start up. And when I look at those young entrepreneurs or those entrepreneurial wannabes, has the qualities that you're looking for in the management team changed? It used to be back in the day that we would look for people that have tried startups a variety of different times. So it was all about the management team. And if somebody didn't have that experience, we would suggest to them get a board of advisors. But if you've got this data analytics approach, what's that telling you in terms of the importance of the team?
Yeah, again, it's going to vary a little bit by sector. I mean, as you can imagine, if somebody's trying to come up and build a new AI chip, the biggest challenge that we're seeing is that the teams that are having that kind of success, it's a little bit of a dichotomy. What you're seeing is, whether or not it's a Jack Dorsey or an Elon Musk, or a Mark Zuckerberg, by and large, the profile of the most successful entrepreneurs is that they are still pretty young. And so there's also some pattern recognition in that, in terms of how they build their teams, how they focus, their capacity to iterate and move their businesses, and the flexibility around that. But when I had my last startup, and you're trying to raise over 300 million in capital to go build data centers in a globally distributed compute fabric around the planet, we were looking for different kind of athletes. We're looking for folks that had done it 2 or 3 times, had the skill sets and the experience to put that kind of capital to work effectively and efficiently, and had global experience. You really don't need that as much today.
Why not? What's changed in the model such that that kind of experience isn't necessary? Is it because of this low-cost approach? We can just develop something quickly, throw it on the wall, and see if it sticks, and then move on?
Yeah, I think I wouldn't use the over-the-wall metaphor. I think what we've moved much more to is an agile approach, where you have small teams working on problems dynamically with customers and really working very, very quickly to find product market fit. And if you have fit, you're certainly driving from that point to go create value, and working very closely with those customers that are really your core targets, and use that capital along with a reduced cost structure of launching those businesses globally to grow the business very, very fast. So, a great example of that, sitting not far from where you are, I think today is Shopify, which was one of the early mentee companies that I had when I was starting the C100 in the Valley, I guess almost a decade ago. And I think what Harley and Toby in particular did, and this is sort of one of the big pattern recognition things we continue to see, is entrepreneurs really solving problems that they've had themselves. So in that case, you had Toby was just trying to sell his snowboard online and was just really frustrated with the experience of not being able to do that, and then realizing the complexity and the cost of setting up an online store was just daunting for most small shop owners. And just focusing very, very relentlessly on what it took to solve that problem, using modern frameworks, modern approach to engineering, allowed him to build things much faster that had a much more intuitive interface. And so, it's the Airbnbs, it's the Ubers, it's the Shopifys that bring that approach to building companies that can really leverage the infrastructure that's been put in place by the startups that, my generation built, back in the, early to mid 90s. And there's just no need to go reinvent, that compute stack.
If this approach that you suggest, as I think I alluded to earlier, suggests that some of the friction or the bandwidth issue of starting companies has been somewhat reduced, and we should expect to see, therefore, many more innovative companies coming in with that infrastructure in place that you mentioned, the IT infrastructure in particular. So I would expect to see all kinds of really, really different stuff, maybe in 3D printing, maybe in the Internet of Things, all kinds of new ideas, cool stuff in fintech that we simply wouldn't see come out previously because the structure of bringing companies to market was very different. What are you seeing in terms of that breadth of innovation out there?
Yeah, there's no question we're seeing a massive amount of breadth. We're also seeing a massive amount of fast copycat companies as well. And because there really isn't that much growth on the planet right now, if you look at the normal places investors would like to invest capital, really tech is the only game in town. Even last year on the S&P, if you take out the two top tech names, that accounted for just two names on the S&P 500 accounted for over 40% of the growth of the markets last year. So tech is really dominating global growth, which is causing a huge infusion of capital. But the interesting thing is we're not seeing an increase in the success rate. So the success rate is still less than 0.3% of companies that have that kind of performance, and that's continuing throughout. Both going back from before the last recession and on through 2017. And so some interesting questions as to why that is. So why do we still only have really 4 next generation transportation companies on the planet right now of size and scale, and the concentration of capital and private capital that seems to be freely available to those companies and almost at no cost of capital. We're seeing Amazon, really destroy market after market in the U.S. We're seeing Alibaba do the same thing in China with Tencent. So the one thing I would say is the ferocious nature of the competition, the ability to steal, morph, and adapt other people's ideas into your platform very, very quickly. One example would be what Facebook/Instagram has been able to do to Snap and to Twitter. So Instagram was really built to be a Twitter killer, but it really looks like it's pretty much destroyed Snap. And it's really just been a few features that the product manager there, Kevin Wheel, has been able to adapt. Took some good ideas that were not really patented ideas, just sort of what users seem to be enjoying using, and within less than 2 weeks, you saw a huge switch, which again goes to switching costs. We are seeing some really interesting things that I think are also a little bit concerning to folks around physical retail. So if you look at, Amazon's acquisition of Whole Foods, what that really is about, along with Alexa, is disrupting, the complete e-commerce models of the 1990s through 2010, and that's going to be a very difficult transition for pretty much all brands, marketers, to try to navigate through. And so we're seeing disruption of a size and scale that I don't think we've seen before. But again, the winners tend to be relatively few companies that are really going to, harness and take advantage of all that. There are some interesting things that you were alluding to, sort of that sit behind that, and sort of more customized and tailored experiences, whether or not that's 3D printing, where you can have an e-commerce platform that can make you anything you want when you need it. So that, proverbial, Star Trek platform where you can have the computer make you whatever you want, whenever you want, and wherever you are. We're getting very close to reality. If you look at sort of converged space around transportation, where you have companies like Uber and Tesla that are working to full autonomous, where you can basically have any type of transportation from point A to point B when you want, completely seamlessly. All of those things are now not only possible, that they're actually happening in cities like San Francisco.
That's very cool. So you've given us an interesting profile of some of the changes that are going out there in terms of the data possibilities for deciding what kinds of startup opportunities and that whole data analytics prospect into entrepreneurship, which we haven't seen before. I don't think I've seen that too often in terms of using the analytics, as well as this really interesting concept around opportunities structured for adapting the world around the customer. Now, if we think in terms of communities, or in terms of academics sitting in the classroom, or in terms of people interested in investing or starting companies, what kind of takeaways do you have for them, starting with, let's say, academics that are trying to teach these concepts in the classroom, because they're probably still looking at concepts around lean startup. They may be still looking at the traditional business plan approach. What should they be doing in the classroom environment?
I guess my high-level point would be get out of the classroom. So my observation is, if you look at, again, those 631 companies that have that level of success, that are in that 0.3% of the highest performing companies on the planet, I would say 0 of those have come out of any incubator that is related to an academic institution. I'd have to go double check that, but just off the top of my head, it's pretty close to 0. And I think that tells you a lot about, where the sequential thinking and the level of competitiveness that we used to be able to see, plan, and work through from an academic point of view, and why those institutions, as structured now, are honestly pretty useless. Maybe that's a little bit blunt and hard to say, especially as somebody who sits on that top 25 business school advisory board. But I've told them the same thing directly. I think the issue is co-op education is the number one way. I think that academic institutions can still be a valued contributor to the solution set here. The only institution that I know that's done a great job of that, on a repeated basis, is the University of Waterloo. There's a reason why they're the number one recruited school for Google, Facebook, Microsoft, Twitter, Amazon. I can go down the list, but basically every company that we've come to know globally recruits that institution on a regular basis. And when they recruit, it's unlike any recruiting thing you've ever seen before. The student sits in one room, and the companies go room to room to room and pitch them on why they should join. So the question is, why is that? Is it just because the student has had co-op? No, that's not really what what it is. I think co-op is an element of their success, but it is not the definer of their success. And I think what Waterloo's done better than any other school I've seen on the planet, and the Israelis are getting probably as close to that benefit as anybody else I've seen, but like the real leverage there has to do with going back and forth and having a dynamic learning environment. So if you're an engineering co-op student at the University of Waterloo, one of the things that happens is you go and do a co-op term at Microsoft, at Google, at Facebook. You come back. When you come back, the first thing you're asked to do is rate the education you received from your professors the previous work term. And those professors and the work product and the information that was given to that student, is rated, and that feedback goes back into that professor's evaluation. So unfortunately, most academic institutions have this sort of publish or perish, tenure approach to looking at things over 10 or 20 years. And in a lot of fields, that still works incredibly well. But in a very dynamic, tech-driven environment that we're in now, where, teaching kids how to use frameworks from Michael Porter from a business point of view that were, conceived in 1975 as a way to do a business plan, or teaching them how to do COBOL or basic level programming, I think that's going to be a useful skill when they get to the workforce. It's just anathema. And I think that's why you have people like Peter Thiel who's saying, why would you go spend, 4 years of your life and $200,000 in the U.S. to go to university? This whole drop out and be part of the real world movement that, Gates probably was the first entrepreneur to have that size of scale of success, dropping out of Harvard early. Certainly, Zuckerberg is sort of the next example people point to. Peter Thiel is another one, but it does point to, I think, a fundamental flaw in how academics institutions are structured, how academics are rewarded within their institutions, how they're thought to interact with the world. And so I think we're going to move much more to sort of a Peter Thiel type approach. Probably the number one educational institution on the planet right now, in terms of continued and repeated success of building great companies, is Y Combinator, which is not an academic institution. So I don't know if I'm answering your question or maybe being too aggressive given our audience, but that would be my opinion.
No, it's a great answer, and it gives a lot of takeaways and indicators for the academic side of the. What about in terms of, do you have any words for the practitioners? And they may be either investors, community associations, or entrepreneurs themselves. Do you have one or two words for them, like one or two concepts or pointers?
I think it really depends on where you are, but there's no question about in a fully interconnected world, there's no reason why you couldn't start a $10 million plus company anywhere on the planet. But you do have systemic advantages in certain places. So the systemic advantages that we're really seeing are in sort of large metropolitan cities that it's easy to attract young engineering talent to, which is a big structural shift from what the Valley used to look like. It used to look like, these big industrial parks where, block after block after block of buildings of Cisco or Intel, or and then you have a block of smaller strip malls that look where startups were. That's where my last 4 startups were built, was in these pretty cold, unconnected businesses that weren't that interesting. The shift has been pretty dramatic over the last 10 years. So if you look at New York City, it's destroying Boston in terms of the hub of East Coast activity. If you look at San Francisco versus the Valley, quote unquote, the Palo Alto, Sunnyvale area, San Francisco is where all of the interesting startups are now. If you look at the 631 private companies, the highest density is 50% of them are within 10 miles of San Francisco downtown. Globally, Beijing and Shanghai also have obviously a high density, and Berlin is doing very well. It's sort of a part of what's in Europe, but you still have half the alpha sitting in Northern California. If you add New York, Chicago, Austin, maybe a little bit in Boston and LA, into that, it's about 75% of the global alpha still resides in the U.S. If you had another 20% out of China, you're looking at a pretty thin amount of success that's being spread out across all of the other geographies. And the challenge there is, what, as a young entrepreneur, do I want to do to make sure that I'm not at a capital person or disadvantage really on information, I think is what it really comes down to. Because if you're in those cities, in those hubs, the level, and I put Toronto as one that's also up and coming, I think very quickly, the Toronto-Waterloo corridor, your ability to have access to people, capital, and information at a very high cadence rate and with fluidity will make the difference of success and failure for most companies. And so if you take the example we talked about earlier, Shopify that was based in Ottawa, when they started that company, they could have started it, pretty cost effectively, probably in Canada, sitting in a telecom, park, out by Nortel, out in the boonies. But instead they chose to put that startup right downtown in Ottawa. And as IBM and Cognos and a couple other software companies were basically getting wrecked by the recession, they were able to pick up really great software talent and young talent and provide them the sort of the cultural and the experience and the lifestyle that those young entrepreneurs wanted and those young engineers wanted and could compete very successfully for that talent. But they also spent a lot of time, an immense amount of time in San Francisco and online and using communities like Y Combinator to really learn very quickly so that they weren't at an information or capital disadvantage sitting in what otherwise would look like a pretty unusual place to start one of the hottest companies on the planet, now worth over $10 billion.
Very cool, Chris. A great set of takeaways for our listeners there. And I want to thank you for taking the time to speak with us today, and wish you all the success. And that's it for our podcast today. Thank you very much, Chris.
Happy to do it. Thanks for the invitation. Take care.
Okay. That's it for now.